Sell stops. So now I want to look at bullish institutional reference points and discount arrays. These are the areas on the charts where buyers will look to capitalize on price and initiate long orders. So we'll look at sell stops. Sell stops will be found below swing lows. So whenever you see price form a low in the market, you have to assume that there are institutions buying that low, and those institutions are going to place sell stops below their entry price as protective stops to ensure that they don't lose more than they can afford to in a situation where the market goes against them. Now, you can also find sell stops below relative equal lows. When you see a candle reach a certain price level and react away from that price level, and then comes back to that price level, finds support there again and reacts away from it, forming some type of equal lows or relatively equal lows, institutions will buy that low and place protective sell stops below that low. Now, below trend lines. So with uptrends, you see uptrend trend lines. Price action breaks below that trend line. Price is more likely reach for the stops that are resting below that trend line. Now, sell stops, you already understand the market efficiency program. Buyers with large amounts of money need to pay their buy orders with what? Sell stops. That is why the market is looking for sell stops. That is why buyers will be at sell stops. Now, the bullish rejection block. Bullish institutional reference points, discount array. The price trades into the support level, and a strong reaction creates a long wick. So, from this diagram, we see a bullish institutional reference point. That's a support level delineated by a green line. And what happens is that we see 3 down close candles, the last one forming a low just above the support level. Now, the candle that does touch the support level is an up close candle, and pay attention to the bottom portion of that up close candle. You see that it has a long wick all the way from this low to where it opens at, forming the low of the candle. Now, price creates a long wick after a strong reaction. Now, the confirmation is in the next candle. So the following up close candle needs to trade into that candle's wick. But just like the bearish rejection block, this bullish rejection block as well, we do not want to see price trade lower than that low. In other words, we want to see price, this candle, just as it did, trade into this candle's wick, but it must not cross the slope. If it does cross the low, then it invalidates this bullish rejection block setup. And how you trade it, your entry technique is going to be to buy the close. So after we get this confirmation up close candle, you want to buy the close of this candle, and you can set your stop below it, expecting that price should not reach for below the low of this candle, seeing as we have already rekindled the remaining long positions that were residing in this wick. Okay. Now, ladies and gentlemen, when the market is trending upwards, when that trend begins, I want to introduce you to the bullish rejection block. The bullish rejection block is a liquidity pool, and it is a discount array, meaning it is an array, a region in price where buyers will look to capitalize on price. It is a discount array, and it's a price pattern that you can observe on the chart with candlesticks. So the concept of order blocks of the bullish rejection block, as I explained in the presentation, is that you have a suspected bullish area that the market trades into, right? So for us in this scenario, in this example, that suspected bullish area is the black line delineated at price level 4,957.42. That is a price level that we're paying attention to. Why? Because if you zoom out on the chart, on the daily chart, In the past, on Tuesday, the 23rd of April 2024, price respected that level before making this monumental rally upwards. Okay? So we expect that buyers should come to the market at that area. So when price occurs, this is how it happens, all right? So when price occurs, you see a big up close candle form at this price level after price touches that key level. Now this candle has a body and it has long wicks on both sides. Now do you see how the next candle trades into the wick of the previous candle? So after price rejected off this key level, 4,957, the next day's candle was a big down close candle. You look at the range on that candle, and you notice that the bottom wick of this candle just trades into the wick of the previous candle, but it doesn't trade past the low. And guess what? After trading through that candle's low, after trading into that candle's wick, the down close candle eventually rallied up and went all the way beyond the previous candle's high before closing. And then you have price shoots up, big bullish candle. Bullish candle also doesn't trade below the wick of the previous candle. And you see how price shoots up off of that rejection block. So the rejection block is this candle that occurs at that support area that forms a long wick. So when price confirms it is when the next candle trades into that long wick, failing to go beyond it, and then trades higher than the previous candle's high, which is confirmed by this down close candle. So what you want to do when you see this type of thing is now you can buy the close. So this candle, imagine you bought the close of this down close candle, your entry point would be right here. Say the close of this down close candle at 4,982. That would be your entry price, right? And you can take that long trade and have an entry with your stop below the low of that rejection block, and you can target price to have filled this gap that occurred here. That would already be a 2-to-1 risk to reward trade for a swing. You could have targeted for price to fill the gap above it, or for price to take out the buy stops resting above this high. And do you see the risk to reward on this trade? So this is the rejection block. So the bullish institutional reference point, we'll take a look at the bullish common order block. Now the bullish common order block is the lowest down close candle with the most range between its open and close near support. So take a look at this diagram, and we see bullish institutional reference points, which is delineated by a green line. Support area, we expect support, buyers to step in. So price trades down close candle, down close candle, down close candle, all the way into this institutional reference points. And what happens here? We see we pay attention to the down close candle, the lowest down close candle that traded into that reference point. Now confirmation for this setup is that the next candle that forms, we want to see should be an up close candle, and that up close candle should trade higher than the high of the previous candle. Once that happens, the order block is confirmed, and you can look for an entry. Now, your entry technique is after price trades through the high of the bullish order block. When price returns back to the high of that bullish order block, or to the mean threshold, which will be the 50% of the body, like if you take the range of this body and 50% and draw it out, you want to see a strong reaction of price away from it. So after price returns to the high of this order block, or the 50%, we should see a strong reaction upwards. So that's how we're going to look to enter. And your stop should be below the order block. So this is what bullish order block looks like. You see the bullish institutional reference point, delineated by a green line. See, when the bullish order block is the lowest down close candle, which will be this blue down close candle that trades into that support area, and then it was confirmed when the next up close candle traded above the high. So this was the high of that bullish order block, and the candle that succeeded it traded higher than it. That confirmed it. So our next candle, you could buy the close of this candle, which is stop below the low of the order block, and the next candle does trade back into the order block, trades into the 50%, and you see a reaction upwards. Now the idea for the order block is this: institutions who want to buy at large quantities, they know that there are going to be orders available to pair with them at this support area, the stops. So although they want to buy, they're going to sell the market lower so that they can get into their long positions at cheaper prices. So when they do that and they buy at those cheaper prices, they force price upwards. So when price trades upwards, now the initial short positions that they took into the market to send prices lower is now losing money. So when they get the chance, when price returns back into that order block and they get the chance to close their short positions that they used to take the market lower, what do you use to close a short position? You use buy orders. So those buy orders plus the opportunity to put in more long orders into the market causes more lethargic movement upwards. That, ladies and gentlemen, is the science behind the order block. Ladies and gentlemen, so this is the bullish order block. All right. So the bullish order block is an institutional reference point. It is a discount array. So when this price pattern forms on the candlestick chart, you know that bullish institutions would look to capitalize on price in these regions. Okay. So the concept of the bullish order block is that it is the last down close candle into a support area. So the last down close candle that you see trade into a support area. Now, into more detail, that candle should also have a good amount of range. So when you look at these two candles on the chart, you will see that we have a down close candle succeeded by an up close candle. Now, this down close candle forms a low of 4,910. We'll assume that it was into a support area. So expected bias to be at the support. And then you see how this next candle trades to form a high of 5,481.34. Now the previous candle's high was 5,267. So this next candle trades are higher than the previous candle. Okay. So now this confirms the order block. So the order block is a down close candle that trades into a support area. Now it is confirmed when the next candle, which should be an up close candle, trades above the high of the previous candle. Now when this forms, how you want to trade this is that you will look the key areas on the order block that you want to look to trade from are that sometimes price will react from the high of the order block. Another time price will react from 50%. So the mean threshold, which is like 50% of the body of that order block. And the other times, price can reach for below the low of the order block. Okay? So these are three levels on the order block that price can reach for. So when price breaks out like this and confirms this order block, you want to see price, then retrace somewhere in one of these levels before taking off again. So when price trades back into one of these levels, you can now take that trade. So let's see how it unfolds. So the next candle trades lower. The candle traded into the 50% region of the order block. And do you see the momentum? So after the candle traded into the 50% of this order block, look how it skyrockets, and there's so much buying pressure that a gap occurs. Oh, and boy, it goes off the chart. That, ladies and gentlemen, is the bullish order block. The bullish breaker block. Bullish institutional reference point and discount array. So the bullish breaker block is an up close candle or range in the most recent swing high before an old low is violated. The sellers will look to mitigate the loss when the price returns back to that swing high. This is bullish. So take a look at this diagram. We have the bullish institutional reference point, which is a support area delineated by a green line, and then you see price trends downwards into that support area. There you see buyers coming to the market with willingness to take market higher, as shown by this impulse swing, and this is what we talk about. That is the up close candle or the range in the most recent swing high. So that attempt by buyers to push prices upwards creates a swing. This point before this reversal is considered a swing high. That is the high of that swing. So this will be the low of the swing. This will be the high. So this high is going to be the bullish breaker block. So then price trades and violates the old low. So this was the old low I talked about. Price violates it. It goes lower. Then spikes upwards. So when price returns back to this swing high, what do you want to do? You want to buy. Beginners, I advise you buy here when price returns back to this swing high. Pros, you know the deal. You're already anticipating a breaker off of this level. You know that early buyers come to the market where they're going to have their stops. They're going to have their stops resting below the swing low. The market maker is going to want to reach forward. He's going to want to reach for sell stops. He's going to want to reach for where there's liquidity. There's liquidity under the swing low. Remember in the presentation, I told you there's liquidity where? Under swing lows. So those stops, those sell stops, market maker is going to reach for that area. And buyers will get to pair their buy orders with the sell stops. And when they get to pair their buy orders with the sell stops, price reacts sharply. So you can trade it this way. So this is what it's going to look like. This is the reaction, swing high, the breaker block formed here. So that reaction, after violating this old low, send price upwards. When price retraces back into that range, we hit the same price level that price reacted away from, forming that breaker block, forming that swing high. And when that happens, delineated by this chopped blue line, see a sharp move upwards. So you can buy that move. All right, ladies and gentlemen, let me introduce you to the concept of the bullish breaker block. So the breaker block is a bullish institutional reference point. It is a bullish array, a discount array. When this pattern forms and price returns to the bullish breaker block, institutions will look to capitalize on long positions at those price levels. Now we can observe this chart, price action on this chart, right? And this is what a bullish breaker looks like. So you can see that price makes its initial upswing from this low to this high and then pulls back before making another upswing, right? So principle is that this low should be protected and this high should be taken out. But the bullish breaker is the price pattern that occurs like this, right? So you have a push up and then price retraces back down and then a push up And price retraces lower. See how price retraces lower than this previous low when it comes down here? And then that should lead to, do you see how this low gets violated? When price comes here before shooting upwards. So we have the same scenario occurring here. Price makes this and price makes this expansion upwards and then contracts, then another expansion. So then price contracts all the way and runs out. Do you see how we run out this previous low? We run it out right here. But from running out the previous low, price goes higher. Alright. And do you see how this is the same as what the diagram I've depicted here on the right? So how do you trade this setup? Well, how you trade the setup is this. When price breaks this high, if you pay attention to the right, when price breaks this high over here, that bullish breaker is confirmed. So what this means is that the institutions who sold short here, as price has now gone above this high now where we are, those institutions are under the water, they're losing money. So if price can return to where they got in, they will look to close their sell positions. And how do you close? You close with buy orders. Okay, so that would inject even more buying pressure into the market. So it would look like this. You want price to return back to that low, and then you want an expansion. Okay, and on this chart right here, that's what we have taking place. So you can see that price has, this low has been run here, right here. This low gets violated. So the last candle's body, the entire range of the last candle, is the range that we'll look for to enter for buys when this breakout block is confirmed. So this candle that breaks past this high confirms this breakout block. So when price reaches this high and then returns back down, we're looking to buy when we see price action confirm our thesis when price enters back into this range. The range I'm talking about will be the range from this candle, which is the highest candle in that swing upwards before the breakout block was formed. So this range is what I'm talking about. And you notice how the bodies of these candles, none of them trade lower than the range of this candle. You know, the body is where the institutional volume is in. The wick is where retail orders and limit orders reside, but the volume of buying and sell orders are in the bodies, and you see that the bodies don't go outside of this range. So what happens after price changes in this range? Now you see that Tesla has now shot up out of this range, and Tesla will likely go up and trade into the wicks of these candles. So take one more good look at it. This range here, that was going to be a breaker, and that's what we have occurring here. Now let's take a look at the bullish failure swing. Bullish institutional reference point, a discount and raise. Now the definition of a bullish failure swing and what it looks like. The bullish failure swing is a range or up close candle in the most recent swing high prior to a failed attempt by price to violate an old low. So you see in this bullish setup here, see support area delineated by a green line. There was a price decline. Price reached for this support area, and buyers come into the market. We see an up move, a rally. That rally is what we're talking about when we say there's a bullish range or up close candle in the most recent swing high prior to a failed attempt by price to violate an old low. Prior to a failed attempt. So the failed attempt is this downswing here. So sellers try to sell the market lower, but they can't send price any lower before buyers rekindle more long positions into the market and send prices higher. So the idea is that if price should return back to this swing high that was formed here, this failure swing formed here, sellers who short the market on this move are now losing money. So if price returns back to this failure swing up here, this swing high, they get the chance to close their positions for net zero and not lose any money. So they're gonna do that. And when you do that, you know that if you sell, how do you close your sell positions? You gotta buy to close. So that's bringing more buy volume into the market. So entry technique is that when price returns back to that level, you also want to sell at that. You also want to buy at that swing high. And this is what it will look like. Delineated on support area, green line, bullish institutional reference point. You see downwards movements towards that level. By make an impulse swing, then retracement. That impulse swing creates a swing high. This move downwards fails to take out this old low before buyers step into the market, regain control, and send prices higher. So now, sellers who sold short here, what are they gonna do? They're gonna close their positions. If they get the chance and price should come down here to this swing high, as I did here, delineated by this chopped blue line, they get to close their positions. And how do you close a short position? You buy to close. So when you buy, you put in more volume into the market, and boom. I introduce you to the concept of the bullish failure swing. So the bullish failure swing is the price pattern that you have when price is declining and runs into a suspected support area. Buyers buy up that area, so they show willingness to buy. Then there's another attempt to run down that low, but they fail, and then price runs above the previously created high. So this would then be that failure swing, or also known as mitigation block. So how to trade this mitigation block slash failure swing is when price returns back to this region right here, which was the previously created swing high, you want to look for buys. Concept is sellers who took the short position on this leg downwards are now under the water as price has gone above their entries. So if price can return back to that entry point, they will close for break even. All right. So on this chart, you can see something very similar right here occurring. We're in this low that we can outline. And here price makes an impulsive move upwards, and then we see a decline in price. But the decline fails to take out this previous low. Instead, it ends here very subtly. And then we see price rally up. You feel me? And this rally goes on to make this entire. And that rally goes on to make this entire move. Okay? But like, pay close attention. Because if you notice the failure swing, I told you the entry point for you would be the high of that swing high. So like you see the range of this last up close candle before that decline begins is your entry point. So when price comes to that level, that's where you're going to start looking for entries. And if you look at the high of that candle, which is 5123, look at when price eventually retraces on this down leg here, where does it find support? Find support at that high. The low of this candle is 5250, and that leads to an upwards move. Crazy upwards move. That leads to an upwards move. Okay, so you can find this in other places too. If you drop down to a lower time frame, this area is going to be a failure swing where you have, let's do that, let's analyze that. So you see on the 4-hour time frame, that piece of price action. This is another example of a failure swing. So in that piece of price action, you have a price rally, impulsive move up, and then you see a contraction in the market. And then that contraction leads to a move higher, and this move higher takes out the previous high that was formed here. Okay? Previous high that was formed here. So let me take this makeup of the chart. What is the high of this candle? And the high of that candle is 5330. Now look at, after price breaks that high on this up close, look at the down close candles that trade into, that trade lower. The low of this candle is 5330. The high of this candle is 5330. You see, it's an algorithm that delivers price, so it is to the dot, literally exactly the same low. The low of this candle is equal to the high of this candle, and then the next candle just trades slightly lower before price shoots up. So that is the mitigation block, aka failure swing. A bullish fair value gap is a bullish institutional reference point in this kind of array. It's a range in price delivery where one side of the market liquidity is offered and is confirmed with liquidity void on a shorter time frame in the same price range. So just like the bearish fair value gap, you're going to see a down close candle, or you're going to see a preceding candle, and then you're going to see another candle after the long body candle. But the most important thing is that there needs to be a displacement in price. So you see how price moves upwards sharply in a large body. The body of this candle is significantly larger than both the preceding and the succeeding candles. And there's a gap between the high of the previous candle and the low of the succeeding candle. That high forms a gap. That gap is what we call the fair value gap. So when price returns back into that fair value gap, because that imbalance was created, and I told you the price wants to fill imbalances, when that happens, buyers are going to rekindle more buy positions into the market, sending price higher. So an entry technique for trading the fair value gap is you can buy the market when price trades into that fair value gap. And this is what it should look like. So this is the fair value gap we looked at earlier. You see the big displacement candle. You see that there's a gap between the low of the succeeding candle and the previous candle. The previous candle's high. Now you see that this Wasabi here, this down close candle, went and said, let me find out what's going on. So he tapped into the liquidity that was offered in this displacement. I remember the fair value gap is formed by a displacement of only one side of the liquidity. So in a bullish fair value gap, that one side of the liquidity is only buy orders. Only buy orders filled that area. And there were so many buy orders that some of them didn't get filled. So when price came back and tapped into that area, those buy orders got filled, injecting more buy orders into the market, being executed, and boom. Followed by an up close candle, big body. Alright, ladies and gentlemen, so I want to introduce you guys to the concept, to the bullish institutional reference points we call the bullish fair value gap. So the bullish fair value gap, I've told you in the presentation, is an imbalance in price to the upside, which causes a gap or a vacuum in price where only one side of the market's liquidity is delivered. So in a bullish fair value gap, that gap that's created, only buy side liquidity is offered. So if price can sell back into that range, those buy side liquidity can be executed, and price will be free to rally higher. Okay, so now look at, if you observe these three candles to the left of this chart, you see that the first one gives you an up close candle with a body and a wick on either side, and then we see a larger candle with mainly a body, and then you see a third candle with a body and a wick. Now notice that there's the low of this candle is how we'll define the fair value gap, and the high of this previous candle, which is right there, So you see that there's a gap in between. Now that gap is buy side liquidity. So buyers are going to be sitting inside of this area. All right. So when price trades back into this area, you expect buyers to get into the market, and the market should take off. So you expect that at some point in this move up, price will eventually dip into this fair value gap if I continue this move. Okay. So how you want to trade it is when fair value gap enters into, when price enters into the fair value gap, you want to buy the fair value gap, and you want to put your stop below it. So let's see. So when price trades into the fair value gap, you want to take a buy position. You can put your stop loss just below the fair value gap, giving price a little bit of room to run. You can risk $150 on that trade. Say you want to risk $1,500 on this trade. So you can put your stop loss just below the fair value gap, and you can buy 10 contracts. And you can take profit, because if you're trading a fair value gap, then we think that price is going to go higher, right? So your take profit. If we decide to, since look, we're not going to look at what's going on behind the chart, right? We're just going to assume that this is what we're starting off with. I wish the candles get bigger. Hold on. We're just going to assume that this is what we're starting off with, right? So we know for sure, I've told you many times, that sellers sell the highs. So above the high, there's going to be what? Buy stops. So we can comfortably know that there's going to be people to sell to. There's going to be willing buyers above this high. So we can put our take profit there. And let's see if the market trades. And you see the next candle, reaction off of the fair value gap, and now the market is rallying higher, and that's take profit. I see the market moves, and the market keeps going higher. The bullish institutional reference point, this kind of array, the bullish liquidity void. The liquidity void is a range in price delivery where one side of the market liquidity is shown in long, one-sided range or candles. Price would typically want to revisit the void of contrarian liquidity. So a lot of times you see that when the market expands, it does so in like a series of big body candles. Like this, for example. The market moves up, but you don't see any down close candles, and you see the range of each of the up close candles. They are all fairly large. And they are mostly made up of body, not wick. Most of the candles are made up of body. So that creates a void. So what that is there's an imbalance in price, and price is delivered similar to a fair value gap on one side of the market. So in a bullish liquidity void, price is delivered only on the buy side. Now the thing about liquidity voids is that market loves to fill voids. So when the market creates a liquidity void, you want to trade against that void when it is complete, expecting that the market will attempt to fill that liquidity void. And that's why I said it here, that price will typically want to revisit this void of contrarian liquidity. Ladies and gentlemen, this lesson will talk about the liquidity voids. So liquidity voids are discount arrays, they are bullish institutional reference points, and then liquidity voids form when the market is consistently delivered only on one side of liquidity, and you can see it by up close candles successfully just overlapping one another. So to this diagram here, you can see that we had this trend starts with an up close candle at the bottom, have another one here, another one, another one, another one, another one, another one. So you see consistent back to back up close candles whose bodies just overlap one another. So when you have price action like this, this is a liquidity void. It is void of sell orders. That is why you have ranges where it's just buy orders, buy orders, buy orders, buy orders. So the thing about liquidity voids is that, like the universe, the market loves to fill voids. So when a liquidity void is created, the market will look to fill it and rebalance, and that is what happens in this scenario. So when this liquidity void forms and then price action change bearish, you could trade that market, trade the short position in anticipation of the markets, in the market's attempt to fill the liquidity void, which it does right here. And after filling the liquidity void, find support and then rallies up again.